Good morning. I'm John Christenberry with CBRE. We're super excited to have everybody here today to talk about top issues with M&A and how you can achieve a higher valuation. So agenda today, we had our breakout room networking. That was a big request from you all, is to add some networking to our virtual program since we don't have the ability to do it live and in person. Hopefully that'll come back sooner rather than later. Mike Prager was kind enough to offer up their space to host, and we made the determination, I think, a month and a half ago that probably just wasn't going to happen. And so hopefully Mike will be able to host here later on next year as things hopefully get back to normal. So running over to our sponsors, just want to thank our sponsors of TER. Amelia, next page, please.
And John, let me just say too that Michael, why don't you take us on a quick tour of your building behind you and tell us a little about that? We can't be there in person.
Yeah, no, we always get excited when we have an opportunity to host groups and meetings at our new campus here in Charlotte. We, in partnership with the city and the state, developed a part of the city called the Music Factory District in downtown Charlotte, which was really focused on live entertainment related to live music and different venues related to bringing kind of people together around live music within Charlotte. There's 13 venues as part of the Music Factory, and so we built our campus here beginning in 2017 and currently have 3 locations within the Music Factory, and getting ready to kick off one of our new buildings here shortly. Probably it would be pushed into kind of the first part of next year.
It's very exciting.
Yeah. Very exciting real estate project we have going on. So our sponsors here, thanks Mike, our sponsors here, CBRE, Commercial Real Estate, Morris Manning, Martin, Signature Bank, MBL Advisors, Dixon Hughes, Goodman, Hallee Partners, all thank you so much for being a part of TER. Zoom etiquette, I think everybody's been on enough Zoom calls. We know the dogs are barking in the background, kids are screaming in the background. If you wouldn't mind just muting your computer during presentations, and if you want to use the chat function to ask a question, please do that, and set it to speaker view. That way you get to see who's speaking when. And just note, we are recording this for educational purposes, and we do distribute out the PowerPoint presentations after the end of our TER program. I'm going to kick it over to John Yates to just hit on our mission before we get started.
Thank you, John, and thank you for your leadership as well. So the TER Technology Executives Roundtable mission is to provide a unique forum for member CEOs, CFOs, and executives of fast-growing tech companies in the Charlotte area to share, challenge, and test their ideas freely so they're better equipped to run their companies. And the unique part of TER is that it is part of an affiliated network. TER Atlanta was the original Technology Executives Roundtable group that was founded, believe it or not, back in the 1980s. And it's grown since then. And our affiliated Technology Executive Roundtable TER groups include TER Charleston, TER Upstate in the Greenville-Spartanburg area, TER Atlanta, and soon to be TER Florida. So it's a way to bring together tech companies, particularly fast-growing private tech companies that are in the Southeast, and to share some pretty high-level topics for them that relate to matters of interest to CEOs and CFOs. Now, our panel today is going to focus on practical lessons for a successful M&A tech deal. And as I think your panelists will tell you, the activity has actually picked up. So it'll be interesting to get their observations in that regard. And I'm very pleased that the moderator today will be Amy Singer. Amy is a partner in the corporate technology group at Morris Manning & Martin. She also focuses extensively in representing fast-growing tech companies, including many in the Charlotte area. And she does a lot of work in the mergers and acquisitions and private equity field as well. Amy was also very involved with the Map Anything transaction. She represented Map Anything for many years and then also handled the Salesforce sale and is involved with other large companies, including MailChimp, Sage, and a number of other fast-growing businesses in the Charlotte area. Quickly going through the panelists, We're very pleased that Murphy Clark is with us from Red Ventures, and Murphy is the Executive Vice President of Corporate Strategy and M&A at Red Ventures. He has a strong background in investment banking and private equity and M&A through Wells Fargo Securities. And Murphy will tell you a little bit more about a very exciting transaction that they are just announced with CNET, and an interesting opportunity to close a deal, I think, in a very unique environment. So Murphy, we're very pleased to have you here, and very pleased that Red Ventures is a key player here in the greater Charlotte area. Leroy Davis is also with us. Leroy is a partner with 7 Mile Advisors. 7 Miles, as many of you know, is located uptown. They've been focused nationally in representing in the investment banking area, technology and business services companies, and Leroy's been involved in a number of major transactions. So we'll look forward to his insights regarding market conditions. We're particularly pleased that KC Kanoff is with us. KC is with Mainsail Partners, and KC, thank you for getting up early from San Francisco. You were kind to do that. You look like you're ready to go today, and we appreciate it. KC's private equity fund, Mainsail Partners, is a leading tech investor in the private equity area. And very significantly, Mainsail is also an investor in 2 Charlotte companies. One of those is Century One, and we were very pleased that Bob Potter, the CEO, hosted our first meeting of the Technology Executives Roundtable Charlotte many months ago. So KC, thank you for being with us. A deep background, and as it indicates on the slide, she's responsible for originating, executing, and overseeing these software investments for Mainsail. And Hallee Moore. Hallee is an associate in our corporate technology group, and Hallee has the unique distinction of being one of the leaders in dealing with significant and really complex M&A and private equity transactions. Despite Haley's youthful appearance here on the screen, she has been involved in some of the most sophisticated corporate transactions for tech companies. She also has a unique specialty in the areas of risk management, and she'll probably talk a little bit about one of those areas, representation and warranty insurance, which has popped up in a lot of these deals now. And finally, Michael Prager. Michael, we're so appreciative of you being with us, and again, offering up your answers, which we look forward to taking advantage of maybe next year. And I'm sure he'll be ready for it. CEO and co-founder of Abbott Exchange. Michael has grown the company to be one of the leading unicorns in the industry. It's a global unicorn as well. And I think, Mike, recently I read in Charlotte Inno that you raised another $66 million, and I think that brings capital raised for your company at Abbott Exchange to well over $450 million. So really an outstanding company and an outstanding example of what's happening in the greater Charlotte area with respect to the growth of technology companies.
Yeah, John, we actually, the round was, it ended up closing at $600 million, which started out as a $150 million round, but then got upsized to 600 based on demand.
Wow. Well, you have to tell us more about that because that's quite an upsize, Michael. Congratulations on that. Fantastic. It's also great to be able to bring that kind of capital to the Charlotte area, which it takes companies like Abbott to be able to attract those funds. So thank you. And Scott Linch is going to give us a little bit of an overview here. Scott's a partner and head of the private equity practice at DHG, a national accounting firm. And we've asked Scott to maybe start the program here and give us a bit of an overview about what the status is in the current M&A market. So I turn it over to you to run through this slide, and then we'll move right into the panel.
Thanks, John. Appreciate the intro here. Excited to be part of this panel again, this program again. I think last time when we were together, we did a little survey as part of the presentation, which was kind of interesting as to when we thought deal volume would get back to where it was pre-COVID. I think there was a lot of people saying it would be sometime next year. I think 20% expected it this year. Most people were saying next year. I think John may have had something that said never as one of the choices, but hopefully that's not going to be the case. But so it's kind of interesting that we got together and talked about what was going on sort of in the trough of deal volume. And it's been exciting to see that the deal volume has been picking back up. Obviously, the first and second quarters were down compared to historical quarters. The data we have on the screen for the third quarter is really through September 15th. So there probably likely will be some more deals closing, but you can still see it's down compared to prior years. But what we've seen, and I think in the market, everyone's seeing the same thing, the activity has picked up. Whether the deals close in the third quarter, maybe not, but we expect a really strong fourth quarter. And, you know, it's driven by a few things. And obviously there's a bunch of money on the sidelines. People have been waiting for opportunities to get deals done. I think folks are learning how to do business with COVID and learning that they have to, you know, move on and continue to make investments. And all these companies have figured out how to work through it. And so the companies that are still positive and good companies are ones that are definitely getting a lot of attention. I think the political impact here, not knowing exactly what's going to go on with the election, but there obviously is some fear that the taxes could change and that would impact people when they're selling their business. So we've seen a lot of folks think that I would rather go ahead and sell my business today when I know what the tax impact is versus sort of the unknown of the future. So, you know, we really expect a strong fourth quarter as a result. And technology has been driving a lot of the activity. You know, businesses that have recurring revenue businesses, that seems to have stayed strong during the COVID times. And we've also seen the valuations and the public markets in the tech space really thrive. And we've seen IPOs like Snowflake recently. I mean, the market is just pretty hot for tech companies. So that's exciting to have this panel today to give us an overview of what's going on. I know Leroy Davis with 7 Mile is going to give us an overview of what he's seeing from an investment banking standpoint coming up here. And the other panelists are going to be able to let us know a little bit more deeply what's going on in the tech and tech services space. So excited to hear the panel.
Scott, thank you. And I'm going to turn it over to Amy Singer now. And Amy, I think a very relevant first question here based on what Scott just gave us as an overview.
Yeah, thanks, Scott. What a great transition. Thank you, everyone, for being here today. We have a great panel, and the topic is very relevant to Charlotte's growing tech industry. So the first question is, for you, Leroy, what is your current assessment of the M&A market, and when do you see it returning to normal to the extent you don't think it has yet?
Thank you. It's a good question. So as a firm, we've always been very focused on IT services, digital transformation, things of that nature since we got started. So we use words like fortunate, grateful, lucky, things like that to describe where we see things. I mean, we'll close more transactions this year than we did last year. If you would have told me we would lock down the global economy and tell people it's illegal to go to work and we'd close more transactions, I would not have believed you. So we're sort of shocked and awed about what's going on. And with respect to return to normal, we actually, from a business model, I'm approaching this from the lens of a business model perspective. We don't think we will return to some status quo ante, some pre-COVID. I think businesses have realized that that digital transformation is a catalyst for growth. The whole work from home experience has been so surprisingly successful to most companies that we believe and we see with our client base that people are going to look for other digital transformation initiatives that they may have been sitting on that they weren't frankly aware of or capitalizing on in the future. So from an M&A perspective, and within the context of digital transformation, it's as good as we've ever seen it. And we think that that's a long-term trend. We don't think it's a blip. And we think that the competitive differences with companies and the differentiators with companies will be less about what particular industry they're in. Are they in consumer? Are they retail? Are they healthcare? What have you? It's more going to be differences between different companies within those industries, meaning have they adopted e-commerce or other analytics or data science? Have they adopted techniques within those areas and adopted those as a part of their business model, or have they not? And I think those that look for sort of a return to pre-COVID way of doing business is, I think, a flirtation with obsolescence. I'm being a little hyperbolic there to make the point, but what we're seeing within the clients that we're working with is so extreme. We wanted to make that point. So overall, within the context of the companies that we're dealing with, the market is exceptionally good. I'd say that it's kind of the same group of buyers and investors that were interested in these transactions prior to the pandemic, plus a bunch of folks who just got the memo, who did not have exposure to it, who are looking for it. So we're seeing our processes, whether it be, private capital or, sell-side M&As or strategics, have more robust, be more robust, basically have more buyers and investors than we had previously.
Hey, Leroy, who are you with?
7 Mile Advisors.
Thank you.
Thanks, Leroy. So Murphy, in light of your most recent deal signing, what do you think about the M&A market? And is it your opinion that we've returned back to normal or headed that way?
Yeah, that's a great question. Thanks for having me. First of all, I have to admit, as a strategic buyer, how massively frustrated we are with this market, right? We had 2 LOIs going into COVID. We put both of them on hold, and we really spent March, April, and May putting together a dream shopping list of companies we wanted to buy at what we thought would be great valuations. And so our CEO is a big sports fan. And so the thesis was, let's move a bunch of deals to the 20-yard line in the red zone so that when they come to us, we can be positioned. We actually turned down some opportunities in May and early June to position ourselves with a really healthy balance sheet. And unfortunately, that time never came, right? The stock market bailed out the public companies that were in trouble. The banks, provided covenant relief for many businesses and kicked the can down the road. So we never had that opportunity to buy things on the cheap. At the same time, a bunch of assets have come to market, and within our sector, kind of consumer internet, we saw a massive spike. I mean, people are sitting around in their homes with nothing to do in quarantine, and so we saw a number of businesses that had doubled in traffic. And so over this period of time, so since May 15th, we've actually either announced or closed 4 deals. Two of which actually with Morris Manning & Martin. One was in the mattress review sector, and that business just killed it because obviously people are at home, and then they had their kids who were off at college or elsewhere moved back into the nest, so they needed to buy mattresses. A mental health online business, which all of us are facing that. Anyone with their kids at home full-time realizes that need help with mental health. The CNET deal, which I'll go into in more detail. And then we did a deal for Europe, which has been unannounced. But we're either going to look like geniuses or fools at some point down the road. But we think that in most of these cases, we're paying, I would say, full prices for the assets. There are fewer deals in this market. And effectively, there's more capital out there. And as a strategic buyer, we've seen these processes hyper competitive. In some cases, you're not only paying a market multiple, but you're paying a market multiple off of an EBITDA, which is, kind of fantasy land of, what if COVID never happened, or what did 2019 look like? So on an absolute basis, the valuations are really frothy, and strategic buyers especially are willing to look through that because the view is we're taking a longer term bet on these opportunities.
Hopefully they've started creating a raving fan. We're going to continue to build on that relationship.
So we've seen, deal flow has come roaring back. It's come back, especially in areas initially that were unaffected or benefited from COVID. So online businesses, healthcare businesses, that had seen the benefit. We have now seen, I think, kind of a full-on return of many transactions. And in most of these cases, the view is, we're already back to a normal M&A environment in terms of deal flow. I do think, in most of the financial models people are putting together, what we are modeling out is, at least 2022 is before you see any sort of normal. But I think that is just a proxy for what is 18 to 24 months out. And that actually may not be realistic. So we're seeing the things that we're seeing right now, we're seeing a ton of strategic divestitures. Obviously the Viacom CBS CNET deal that we announced. We had 4 other deals that we're looking at right now that are divestitures, really strategics that are cleaning up their balance sheet and selling assets that they never would have sold if they didn't have to, if they didn't face issues with their kind of current debt situation. And we're also seeing smaller assets. So businesses that are either capitulating and saying, you know what, I've gotten through to the other side here, the tax regime may change. And so therefore, we're interested in looking to sell. What we aren't seeing, one is we're not seeing many distressed assets, surprisingly. We thought we'd see a lot more, but we're not seeing many. And then secondly, for a while, I think we're starting to see this as kind of the, traditional PE processes. We have not seen many of those where we're competing with private equity, but the credit markets are so constructive right now. And my sense is that will start to happen. So that's that. I think overall, we'll see. It's a crazy market in some sub verticals that have seen a massive boom, and that unfortunately is kind of where we compete. And so, the microcosm that we live in, I think, is very different than the broader market.
Yeah, thanks, Murphy. I tend to agree. Back in April, we all thought here at Morris Manning we're going to have a bunch of distressed asset M&A, and it turns out it's very healthy M&A right now. We're not seeing lots of kicks in the valuations, and frankly, it's a very healthy market. So I agree with your assessment there. And let's move to the next question, and this is for you, Casey. Private equity funds have plenty of cash to do tech deals. Are you still busy, and have the metrics for change for investing in tech companies? And also, how are you guys dealing with closing transactions without going to see the company and doing everything remote? How is that working?
Yeah, awesome. Thanks, Amy, and thanks for having me, guys. I'd say we're still really busy. Activity is kind of Scott and Murphy references really picked up in Q3, and we expect it to continue into Q4. And similar themes as entrepreneurs are looking to de-risk, test the market in advance of the election and potential tax changes, and then as well as second COVID wave here. With regards to investment, we actually completed our first platform investment in 2020, about a month ago, in the IT services software market, and are on track to close our second platform investment in a few weeks here. Our goal is to make roughly 4 investments a year, so we're a little bit behind, but pretty close to being on track. And as you were referencing, Amy, all the diligence in our recent investments has been conducted over Zoom. And then we found a way to safely meet entrepreneurs towards the end of the process in person. With regards to metrics for us, our metrics really haven't changed. We're continuing to invest in high growth bootstrapped software businesses. I'd say Mainsail's sweet spot really is in businesses that are between 4 to 15 million of ARR, growing north of 50%, and are profitable. And typically, we're looking for businesses that are exceeding the rule of 40. And I'd say through COVID, within our portfolio, we really re-emphasize profitable growth across the board. And so that remains a real key metric for us here. And if something slowed down or, kind of during COVID or because of COVID, I'd say those kind of types of companies have typically fallen in the too hard bucket. But if growth is accelerating, we're definitely spending much more time peeling back the layers and trying to understand what portion of that's sustainable and then what is not.
Yeah, thanks. And what during COVID, did you take a lot of time to comb through your balance sheets of your portcos? And was there lots of cash invested into your portcos to help them survive? Did you think about early exits that you otherwise wouldn't have?
Yeah, I'd say we were in a really fortunate position, and we didn't have kind of any, we would say, like problem children or companies that needed a cash inflow. And I think a lot of that does speak to kind of our investment style and highly recurring revenue businesses in pretty shielded industries. And so we didn't face as much of that. I would say where we did really, refocus is bringing all of our companies up to kind of profitable growth. With the level of uncertainty and across the board seeing kind of some on new bookings slowing, but renewals holding up really strong. And so I think that helped shield us a little bit from needing to infuse cash into any of our businesses.
Well, that's great news. Great news. So thank you for that, Casey. I think we'll move to our next question now. How have the valuations changed as a result of this pandemic? And I'd like to move to you, Michael, in light of your recent oversubscribed financing, and let us know what you think valuations are changed as the pandemic and where they're headed towards.
Yeah, so first of all, maybe provide a little kind of a different lens to, what Murphy indicated. We typically think of, our M&A as kind of a core part of our growth strategy, but probably a little bit more, kind of down market from the standpoint we're looking at how we penetrate new vertical markets and kind of create, bigger concentrations within the verticals that we're already in. So we're typically, talking to companies between, say, 5 million and 25 million revenue in that quadrant. And I think what we saw at the beginning of kind of the pandemic, people were just really kind of in, let's wait and see kind of, how this is going to affect our business. And then, in the last, 45, days or so, I think it's been, it's really come back pretty robustly in terms of companies now having visibility to, kind of be able to forecast, coming out of the pandemic, how it's going to impact their business, and seeing a lot of it, deal activity. Now, I think, we, took the opportunity, over the summer when we saw what was happening, we said, hey, we think there's going to be a lot of opportunity. And so we took the opportunity based on the demand that we had for, our $150 million round that we started to upsize it to just over 600 million to create kind of that war chest to be able to, be, more opportunistic and move quicker on deals without having to, potentially raise more capital depending on, future deals. So, what we're seeing is, a pretty robust market. There's a lot, there's a handful that we're currently, evaluating, now. And with that, I think, valuation is an interesting question because, I think it depends on what we're seeing. Two key factors. One is kind of the vertical industry sector, certainly things in, the intersection of software technology and SaaS software with payments is a pretty, attractive sector for, the public companies. And, the market's done extremely well related to valuation. But then, if you do get sectors where there's there's more, headwinds and tailwinds, I think it's a different story. And then the other kind of big component that we look at, which, sometimes, gets frustrating, as a corporate buyer like ourselves, is you get really small companies that are not at scale, but they think, they're trying to equate valuations to, public companies that have very different scale, very different dynamics, and try to equate valuation levels to their business, which is, and so there's a lot of, education that usually has to take place, with those type of dynamics to understand, hey, they're at a very different, quadrant of their growth sector. They're at scale. They have a different financial profile, and it's hard to relate those type of valuation metrics to, $3, $4, $5 million business. So those are some of the things that we see kind of playing out, but certainly across the board, it's certainly come back pretty aggressively in terms of opportunities that we're looking at.
Yeah, thank you. I resonate with the small company and the unrealistic valuations. And that's when I rely on someone like Leroy. And you hope that those small companies have a banker or have someone who has enough experience to educate them. But it's sometimes hard to explain that to a small business with, that's founder run, 2 small founders, and they're seeing what's out there in the industry and they want that. So that's a point well taken. Well, thank you, Michael. So we'll move on to our next question now. And this one, I'll tee it up for my associate Hallee. Along with the pandemic, there's been new risks in the area of legal exposure for tech companies, which you and I are very familiar with. How has this impacted the scope of our diligence in deals and any other deal terms that we wouldn't normally see pre-pandemic?
Yeah, absolutely. So as part of our deals, I mean, I guess it's our standard legal due diligence that we would ordinarily do. I mean, luckily for us, we're never really on site with, as part of our due diligence, everything's still online, access through data rooms, via email, et cetera. But there's definitely been heightened focus on the effects of COVID on a business. So this really played out with everything from data privacy, with employment matters, shifting employees to work remote at home, making sure that they're, all set up with their laptops, but everything's being accessed securely. Any risks with employment matters. PPP loans are obviously a hot topic. It seems that every single deal that we're doing these days, there's a PPP loan out there. and trying to decide how we're going to structure the payoff of that, since most of the portals for forgiveness aren't open. There's also been, looking at contracts, making sure that, what are the force majeure provisions in a contract, and as it relates to pandemics, what if you can't practically enforce a contract, or you can't perform under a contract because the people aren't available, you can't come on site to actually perform a contract. Timing of payments is an issue too. Did you extend the time in which that you're going to enforce receipt of payments, loss of customers, any sort of new litigation claims, and all of this is kind of playing out into the purchase agreement itself. So there's some risk allocation there, as far as broadening the reps and warranties and purchase agreements to make sure that it covers all these effects on the business. And then through that, then we're also seeing just broad disclosures around, the effects of COVID on the business, and putting into your disclosure schedules that COVID's like a blanket statement that COVID's has impacted the business and the way that the business ordinarily operated in the ordinary course. So there's been some risk shifting there as well.
Thanks, Hallee. Leroy, do you have any comments on this slide? I know that you are, you can help run the database for lots of your clients, and any particulars since COVID that it's changed in that regard?
I think Hallee did a good job of hitting all the points. I mean, we certainly see the all virtual diligence thing. We certainly see, as Hallee suggested, almost every deal has some aspect of how we're going to handle the PPP loan and forgiveness, and do things get escrowed, or we're just walking away from that, or what are we doing? So that's coming up a lot. The only thing that I would say that I would add that is not necessarily specific to the pandemic, but it's certainly been accelerated by that, is that in this increasingly asset light world we're living in, the spread on book to price, meaning the amount of intellectual property that's comprising enterprise value in these deals continues to increase. We expect that continues. So therefore the legal diligence on that aspect of the deal is, more important than ever.
Yeah, I agree. Well, thank you both. We'll move on to our next question. This one I'll tee up for Casey first. Are you seeing rep and warranty insurance in more deals? And if so, how has it worked and changed the process? I know in Morris Manning, a majority of our deals are policy deals. Are you seeing that over on your side as well?
Yeah, we are. We're seeing it in most of our deals, and then we're actually also including it in the LOI phase. And so during that phase, we'll typically pursue obtaining a buy-side rep and warranty insurance policy as a part of the transaction. We found it's really seller friendly, and it's also something we've been able to bring down to some smaller investments. So we've been able to bring it down to even a 50 million enterprise value investment.
Yeah, that's what we're seeing too. Hallee is actually one of the national experts on rep and warranty insurance. So Hallee, you want to give some feedback on this, on the rep and warranty insurance, and how the prices have kind of come down since its inception, and also what kind of carve-outs we're seeing because of COVID?
Yeah, absolutely. So the rep and warranty insurance remains, a hot to get item on most of these deals, and just being able to get the deal generally. Most deals are being structured, especially in the mid-market, as book policy deals. I have not seen any sort of slowdown, and I would say that, roughly 80% of our deals are structured as a policy deal these days. We have seen some interesting things in the market itself as far as the carve out. So originally, the carriers were not covering anything related to the PPP loans. That was just an express exclusion. These days, they're actually covering PPP loans. Now, whether they require an additional premium, we've seen like 10 grand, 15 grand additional premium if you don't want the PPP loan exclusion. Or, they're just willing to kind of take on the risk there, especially when the PPP loans are actually getting paid off, or you're actually escrowing money as it relates to the PPP loans. We are still seeing broad exclusions with respect to COVID, the impacts of COVID on the business. And so to the extent that, you know, there's a breach of a rep and warranty, the portion of the loss associated with the impact of COVID on the business, whether it's, you know, a customer, loss of customer, a breach of contract, litigation claim, et cetera, as it relates to COVID, that portion of the loss would be excluded. There are kind of some carve-outs that have become standard with the carriers. You know, not to necessarily get into specifics there, but the carriers are starting to cut back just a little bit on what the exclusions are going to be, or how broad the exclusion is. It will be interesting to see how, you know, this actually plays out in any sort of litigation or claims recovery. I don't think we've seen that quite yet, as far as, you know, there being a breach and then the carrier coming back and really enforcing these exclusions.
Thank you, Hallee. Casey, I have a quick question from the chat for you. It says, how do you diligence offshore activity if you can't visit the offshore site? Is it still just by Zoom, or, you know, fingers crossed and everything through a virtual data room? How are you working that?
So we haven't come across that at this point yet. And so I think, though, we would probably try and go visit. At the time we would typically go visit, though, would be definitely towards the end of the process. And so we found a way to kind of safely diligence everything else over Zoom. And then we'll schedule kind of 2 to 3 days in a safe way with entrepreneurs. And I'd assume we'd typically do that with offshore, because that is, you know, really important part of our process.
Yeah, thank you. I agree. So I have 2 more questions for people on this slide. One is, Murphy, I know that with my strategic companies, when we're doing acquisitions, rep and warranty insurance in the past was not very popular. It was more on the private equity side. Are you using rep and warranty insurance with your strategic purchases?
Absolutely. I mean, it effectively is ante for the game for transactions. I think, as Casey said, anything above 50 million. You know, even the deal, one of the deals we did earlier in the year was 40, and we did it. So it's required for a clean transaction for the sellers. You know, we have relationships with a number of the insurance companies. I will say, you know, my understanding going through the CNAT process recently is that there had been some losses. You know, the losses have mounted in a few cases. And some of my sense is some of the insurance companies either raised premiums or backed away. That's a little bit of current intel we got over the past few weeks, but there's still a really robust market. And, you know, I think it's something we're comfortable with, and it's what the sellers are expecting.
Right. And Michael, you too?
Yeah, same thing with us. We've used it in, I think, our last 4 transactions, and now I think it's just part of a, you know, normal course. And even if sellers aren't necessarily familiar with it, it's something that we recommend because I think it is seller friendly, and it's a great way to kind of you know, execute a clean transaction.
Yeah, Hallee and I prefer it also because not only is it a very clean transaction, but it makes negotiating the reps from a legal perspective much easier, right? So you just get a broad set of reps, and the buyer just says, hey, there's a really nice white picket fence around your liability, so you don't really care what these reps say as long as you're not committing fraud, you know?
Absolutely, and especially, I mean, we're a lot of times working with some smaller companies who may not be as sophisticated with just reps and warranties, and so having insurance actually cuts down a lot of that negotiation.
Right, especially with these small companies when you're actually drafting their schedules for them because they're so unsophisticated.
It's kind of become like a standard with respect to caps and baskets and use of mini baskets and double scrapes. I mean, a lot of the indemnity terms just kind of shake out naturally because there's kind of a market standard with, quote, doing a policy deal.
Yeah.
Right. So Hallee, can you talk about what the cost is for rep and warranty insurance?
I mean, the cost has relatively stayed the same. I will say there have been some fluctuations in the market as far as increased premiums, just because some of the carriers are kind of backing away from providing coverage just because, or especially in certain markets, because just the premium didn't outweigh the risk. There were so many players in the market that they were having to cut down on the premium so much that, it just, there's been some bigger claims recently, and it just kind of forced them to back away. But I would say it's still pretty typical, the 2 to 4% of enterprise value, or of policy limits is what you're looking at as far as the premium cost of a policy. That said, most policies are shaking out somewhere between like 2.3 and 2.7%. The retention amount that you'll see is still a typical 1% of enterprise value. That's if the buyer and the seller are kind of splitting the retention. So the buyer takes on the first 0.5% as a true deductible, and the seller takes on the next 0.5% as kind of a standard general cap / escrow.
Got it. Got it. Thank you. We'll move on to our next question. This one I'm going to tee up for Michael and Murphy. Avid Exchange and Red Ventures have been two of the most successful technology companies in Charlotte and in the country. Both have partially grown through acquisitions. How has the pandemic changed your acquisition strategy? So, Michael, I'll go to you first.
Yeah, I mean, I think for us, we use it as an opportunity, to kind of create, a larger capital pool by upsizing our last round, to be more aggressive coming out of the pandemic. We viewed that, it'd be a catalyst for, companies to, look for liquidity. I think, we're still super early in that cycle. But, we are seeing kind of that activity really start, kind of at the end of August, and September has been surprisingly really busy with, inbound activity. And I'd say that's both mixed between, bankers bringing us deals, as well as, just entrepreneurs that we've had long, standing discussions with, being, within the same industry, that now are, thinking, okay, now maybe the right time. So I think, we've seen, a pretty robust market, and for us, it's around really, making sure that, we're focused on the right deals that, strategically really move the needle for us.
Right, great. Murphy, how about you? Do you tend to agree that just what you said is you put together a sweetheart list of the companies you'd like to pursue? How's that going?
Yeah, it's changed. It's a great question. And, I think unlike Michael, we are very diversified across a bunch of industries. So if you think of the 6 core verticals we're in, the financial services, home services, healthcare, education, entertainment, now tech and gaming, we can go a lot of different directions. And so, we really look at, how has COVID changed the world in certain areas? Digital markets in education and healthcare, 10 years of change have happened because of, pseudo regulatory issues have pulled forward that demand in a period of 3 months. We've also had a front row seat, our core investors, minority investors, Silver Lake and General Atlantic. Silver Lake made their name effectively during the last financial crisis. So they led the Airbnb deal, the Expedia deal earlier. GA is in TikTok. And so we've seen kind of the front end of the spear in terms of what they're looking at. So I think there are kind of three major themes we see. One is, where has COVID created destruction, and we are staying away from these sectors. Anything consumer credit related, which is, credit cards, whatnot. Our credit card business is down 90%. Because effectively banks are not lending to individuals with unemployment so high. It's starting to come back, but slowly. But travel, we have the points guy. That business has been beat up significantly. Anything that is physical retail or restaurants. So those are sectors that we said, we're interested, but we don't think the timing is right. So you look secondly at, where have the industries changed and where have you seen a massive bump? And we put those into 2 categories. One is where there are sustainable bumps that have happened, and where are the non-sustainable bumps that have happened in traffic and monetization. The sustainable side of, again, we announced the CNET deal. Our view is, that is a business that CBS paid $1.8 billion for in 2008. And so, buying it at $500 million, while expensive, is an attractive we think we have really attractive metrics on it, but traffic on that business is doubled. It's in tech and gaming and some other areas where you've seen a bump in traffic. We've seen areas like telehealth, online education, online brokerage, business models like Wayfair and Chewy's, that we think, all of those are situations where you've seen a meaningful step change and you're likely not to see a step down. So we're looking for those sustainable areas of growth. We are very cautious around non-sustainable areas, meal kit companies, right? The Blue Aprons of the world or others where basically we're stuck in our homes, so we're trying and experimenting with products, certain areas of social media. We've seen businesses come to market, some of the online fitness apps that have come out, that not the bigger ones, but the secondary and tertiary ones. And so we think those are frankly dangerous, and that you may actually see a deceleration post-COVID. And so as we look at our shopping list, it really is, where has the world changed? What changes are permanent? And where can we play in those markets? So our shopping list is primarily focused in areas that fit that. So healthcare and telehealth related businesses, online insurance is one area we've been looking closely at. The mortgage process, given rates low for the next few years, and then online education, which we think is another mega trend.
Yeah.
Thank you, Murphy.
Yeah,
Casey, I have a question for you. Oh, sorry, Michael, go ahead.
Yeah, I was going to say, just to add on with Murphy, I think, when the pandemic was starting, there was also a mindset of people that, we didn't know what was going to happen in the overall market. So I think the mindset was, hey, there's going to be opportunity here, evaluations are going to be compressed, and there's going to be, more of an opportunity, to buy, to make the acquisitions at lower prices. And I think what's turned out is, that hasn't played out, but the pandemic has actually tested the business models of a lot of the companies we're looking at. And so now that we've, been able to demonstrate, hey, this business model has survived a lot of pressure, over the last, 6 months, we're actually happy to pay, full price per se, by getting quality assets that have been tested during this period.
Right, I agree. So Casey, a question for you. Are you and the other private equity funds actually competing with the Avid Exchanges and the Red Ventures of the world?
I think it sounds like they're a bit upmarket from us, but potentially when Michael said they're going down 5 million ARR, I got a little nervous. But no, I'd say we're typically, most of our processes are pretty proprietary. We're not participating as much in kind of big bank processes. We're starting to a little bit more, but a lot of ours are kind of relationships, probably similar to the other guys, but relationships we've been kind of fostering over the past 1 to 5 years on the long end. And so I think what's been helpful is we've had a long time to track a lot of these businesses, and then kind of seeing performance through COVID and how they've reacted has been really important, kind of where we feel like we can lean in, and we really know the entrepreneurs as well as, know the business models, and they've been battle tested through this time period.
Right. Yeah, the private equity funds have the benefit of long relationships. they kind of grown with these companies. So, all right, we'll move over to our last question. I kind of throw this up as a question for anyone to answer. Many of the smaller tech companies are struggling, and VC money, especially Series A and Series B, may be hard to come by. So more companies are considering an early exit than they otherwise would have been. How are these companies best to position themselves to be more attractive to acquirers? So anyone from our panel, what do you think is best for these companies to do to position themselves to be very attractive and get the most valuation?
Happy to take it from a strategic buyer perspective. I do think, I'd say 3 things. One is, be really thoughtful around the story you're telling to different buyers. It's not a one size fits all. So take the time to prepare the right story for the specific buyer. Do your research on the buyer. Tell the right story to that strategic buyer. What's the strategic angle? Theoretically we should know, right? But sometimes we don't, because we may not be familiar with your business. And then what's the upside opportunity? So do a little bit of selling, almost a customized pitch for a specific buyer. And then I think, it's always important to have an entrepreneur who's thinking, even though you're selling in the short term, that you're thinking long term, you're doing all the right things of the business to prepare it to be sustainable over a longer period of time. Because we don't want to buy a business that has a proverbial hockey stick, and the founder has driven up earnings and contracts and is selling it at a moment where we're going to be stuck holding the bag on the next 12, 24, 36 months.
Yeah, I think what we see is that a lot of, especially more, kind of early stage entrepreneurs, they just try to do too much. And they try to, our term is spread the peanut butter too thin in terms of trying to go after too many markets or trying to, have too wide of a product suite early in their existence. And what we like is companies that actually have a more narrow focus to become really good at developing traction in, say, one particular vertical market, or with a much narrow product suite, but they gain more traction quite faster. And so I think I encourage all entrepreneurs to a lot of times less is more, and to be very focused on either the markets they're going after, even the sub verticals within the markets that they're in, as well as be very focused on not trying to create too big of a product suite too early in your life cycle.
Yeah, I agree.
I was just going to move to you, Casey. What do you kind of do when you're building your relationship to encourage them to be more attractive to Mainsail?
Yeah, I was going to say I completely agree with Michael and Murphy, and I think focus continues to be key, and then refocusing on your unique value proposition is critical. I think with the other kind of two areas I'd say we focus on is really having a good handle on your metrics and then KPIs you use to track the business. I'd say from our perspective, we'd rather see 40-50% growth, strong unit economics, and then strong cohort characteristics versus, say, much faster growth north of 100% with a ton of cash burn and then degrading cohorts. And so I think having that handle on those components is really important. And I'd say through COVID, this kind of goes hand in hand, but really managing costs and demonstrating kind of sustainability through the COVID downturn. I think slow to no growth, but burning cash, I think that's where it can be a really tough sell in this market. And it's important to be able, on the flip side, also block investors just through what those numbers are, and then shedding any light on any noise that's in there.
Yeah, great. I have a question. Founder rollover. So we're seeing that almost all the time with our private equity deals, kind of requiring a little bit skin in the game from the founders. Is that Mainsail's take? And I'd also like to get Michael and Murphy's position from strategic buyers. Are you getting founder roles, or just hiring on as employees, or what?
Yeah, I'd say typically we see that. I'd say our kind of specialty deal is probably kind of a 60-40 type deal, where the founder entrepreneur's rolling somewhere between 30 to 40%. We've also, on the flip side, we're open to 100% deals, but I think we definitely like the rollover into the next deal, with the idea being it's really 2 bites at the apple kind of model. So it's kind of an initial transaction with the liquidity, for all the success to date. But then the real idea is, how do we grow the business together the next 3, 5+ years? And then that second bite at the apple being much larger.
Yeah, I mean, for us, we try to, we like to have kind of a team that we're investing in be part of the growth story with us, own, whether it be their vertical part of the business, or to be kind of, active, part of the team and growing the business. And we have done deals where, it's more of a retirement, exercise for the entrepreneur. But in those cases, it's like, okay, let's make sure the core team stays intact to, really be part of the growth engine for that vertical, part of the market, or that business unit part of the market. And that's how we look at it. So we actually, highly incent and want, kind of the core team of our acquiring companies to, be part of our team going forward.
Right. Murphy, you two on your deals?
It's just up there for you guys too. Are you guys seeing on these large rollovers, you're still putting policies in place? Because I assume that the sellers are required to sell, provide no claims declarations right, for their knowledge of breaches, which gets excluded from the policies. So with these substantial roles, are you still putting in policies on those deals?
So I mean, yeah,
for
you know,
you.
in our case, I guess in our case, you know, we haven't seen a large rollover, you know, in the deals that we've done. So that has not been an issue.
Yeah, we don't either. I mean, I don't know, Casey, you want to answer that question? Because we don't, yeah, we effectively, our experience is, you know, the founders of these businesses are out that we want to keep them for as long as we can. They almost always they're leaving in 12 to 18 months because they're entrepreneurs. They've made a ton of money. Our goal is to try to keep their senior team and create an environment where we can grow the next level. But I think we keep it real that, you know, keeping you know, an entrepreneur who you've paid, you know, 30, 40, 50, 60 million dollars, you know, keeping them in a larger organization is a huge challenge, and you want to put the mechanisms in place, but it's hard to do.
Yeah, I guess I'd say we haven't, I guess, had as many problems with it, or it hasn't become as much of a problem for us. But what we will do kind of from a structuring perspective is adding kind of larger outsized option pools as a way to kind of incentivize the team and the rest of the senior management team with regards to kind of future transaction.
Thanks, Casey. And I want to just take time to thank our panel for being here. Casey, for you getting up virtually in the middle of the night. And I'll turn it back over to John.
Thank you, Amy. Great panel. I think one of the benefits of this panel too has been we focused on issues with regard to both buyers and sellers of tech companies, and especially in Charlotte, where fintech is such a big market. There are a lot of companies that I notice who are involved with the participants here who are potential targets for a number of the folks on this panel, and also some potential buyers. So great discussion and lots of good insights. So I'm going to turn it now over to John Christenberry to talk about our next meeting. John?
So next meeting is set for Wednesday, December 9th. We'll have the same format where there will be networking from 7:30 to 8 to 9. We're lucky enough to have Mark Ventnor, who is a senior economist for Wells Fargo. He's going to talk about the economic forecast for 2021, as well as the impact he predicts for Charlotte's tech community.
That should be a great panel too, John, because I think one of the things that's key for Charlotte is to determine, as we become a city that's really focused in the fintech area, thanks to companies like Red Ventures and Avid Exchange, but also so many of the young growing companies, the impact of the overall economic market condition is really important, and it relates to a lot of relevancy to companies that are trying to raise capital. So once again, many thanks for participation here. This has been recorded. We will be sending the PowerPoint out if you'd like access to it. And if you have other ideas for other meetings in 2021, please feel free to contact John Christenberry, myself, or anyone else that's on the panel, and we'll be happy to share those ideas. Thanks, and hope everybody stays well and has a wonderful day. Take care.